And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday as we get this week underway, and John Penn joining me this morning. We're going to be talking about financial nihilism and a couple of other things this morning. So hang around for that conversation as we join each other in the kitchen this morning. So a couple of things, be sure and get your tickets for the upcoming Economic Summit. It is January the 19th. It's right around the corner. So you need to get your tickets now. Tickets are on sale at the moment. So simply go by our website, realinvestmentadvice.com, click on the link at the top, get your tickets secured. It's going to be a really good conversation. Everything from the future of stable coins and cryptocurrency, the future of artificial intelligence from BlackRock. Of course, we'll be covering markets, bonds, gold, everything else in between. Also, Adam Taggart joined us for live Q&A, as well as Ed Slott on financial planning. So lots of topics. It's going to be a very, very good summit on Saturday. So again, be sure and get your tickets now. They're on sale, and they are going pretty quick. So get your tickets. All right, having said that, let's get into what happened yesterday in the markets. Not a lot. It's really pretty quiet. The most interesting thing yesterday, though, was ISM Manufacturing Index, which came out a good bit weaker than expected. And you know what's interesting about the ISM Manufacturing Index is that it's only 20%, 30% of the economy now. So it's we've transitioned the economy now mostly to services. Soft data continues to read okay. So we take a look at GDP, retail sales, they're doing okay. But the manufacturing side of that ledger still seems to be pretty weak. Now, there's a decent correlation between the annual rate of change in the S&P 500 relative to the manufacturing index, kind of going back historically. And generally, the S&P is doing better when manufacturing is doing better, and vice versa. Of course, over the last year or so, there's been a big divergence between the annual rate of change in the S&P 500 versus what's actually going on in the manufacturing side of the economy. And the big question is will that divergence last, or will eventually manufacturing catch up to the markets, or vice versa, right? So that's going to be the big question. Of course, that all comes down to economics. We've talked about that a good bit before here, is that ultimately economics is what's going to drive markets because that's where earnings come from. And so we'll see. Now, today's daily market commentary, we actually touch on earnings a bit. So if you haven't gone by the website yet, subscribe for the daily market commentary. We send that out every day. This morning touched a little bit on earnings as we get ready to kick off Q4 earnings. It's hard to believe, right? It's already that time back in earnings season. So we're about to start getting earnings here in the next couple of weeks. And right now, estimates for 2026 are very elevated. We have very, very optimistic views. Some of the most significant deviations from long-term earnings growth trends that we've had historically. But the optimism is very, very high for earnings. And again, expectations is that the economy is going to be doing great this year. Earnings will do well. We're going to hit about $1.3 trillion worth of buybacks this year. So, there's lots of anticipation about this year. So, on the optimistic side. So that leaves some room, and the thing to think about is that, yes, it's fine to be optimistic, but when you're very, very optimistic, as most outlooks are right now, that does leave some room for disappointment, leave some room for fragility, and that's just at least some things that you at least want to kind of consider in your portfolio allocation as we start to look out for this year. Yesterday, of course, was interesting in the markets because of the whole issue with Venezuela over the weekends. We saw energy stocks do well yesterday. Early in the morning, the market was kind of very flattish, and energy stocks were kind of the bright spot. By the end of the day, we saw a bigger rotation into other areas of the markets. And this kind of brings us to what you need to know before the bell this morning. So yesterday, again, we saw early in the morning kind of big green spots on the heat map for energy stocks. And by the end of the day, that kind of participation spread over into financials, and we saw a good bit of activity on the financial side of the ledger yesterday. Now, the important thing about this, and we've seen this kind of improvement now for the last really kind of 2-3 weeks, is that we've seen kind of a slow rotation. We've talked about sector market rotations previously, and we're kind of in one of those right now, where we're starting to see a sector rotation from kind of growth to a little bit of the value side of the ledger. Value stocks relative to growth have been outperforming here over the last couple of weeks in particular. And what's interesting in with that is we're also seeing this kind of rotation from the mega cap stocks, which have been kind of the fairly narrow market breadth leaders over the course of the last really kind of year, into some of the underlying areas of the markets. And we saw this yesterday in particular this is a performance of the S&P in yellow. So this is S&P market cap weighted, and the red line below this is the S&P equal weighted index. The S&P equal weighted index actually hit an all-time high yesterday. And again, there's been a big divergence in performance between the market cap weighted index, and that's the Mag 7, that's lifting that index higher versus the equal weighted index. And that performance gap has been slowly kind of compressing. We had previously, when we talked about this a few weeks ago, there was about a 10 percentage point performance gap between the equal weighted index and the market cap weighted index, and that's closed now to about 6%. So we're seeing some improvement in terms of market breadth, which is encouraging. We're starting to see some of that rotation in the markets. I don't know if that's making a statement for the whole year, but it's been one of those things we've talked about over the last several weeks. Previously, we talked about in our portfolios that we started adding in some defensive positioning. We added some financials, we added some additional healthcare, those type of things, kind of moving the portfolio, having given a little bit more of a defensive twinge just in case we do see some increased volatility this year. And again, we're starting to see that in terms of an improvement in the overall market breadth. Again, we're starting to see some of these other areas of the markets beginning to perform better, playing a little bit of catch up here relative to the tech index. So we'll see what happens here. Nothing overwhelming to speak of at the moment. And again, yesterday was just it was kind of a quiet day in the markets. Nothing really kind of going on dramatically speaking. But what was important yesterday is that again, we're still above this 20-day moving average. Things are doing okay. We're about to trigger a short-term MACD buy signal on a momentum basis. That's helpful. Relative strength turned up yesterday. So if we can get some follow through today, that will be helpful. Again, markets are very near all-time highs, and we've been in this consolidation range now for about 2 months. So again, if we can get a breakout above this consolidation range, that should give the market a little bit of a tailwind here. Anyway, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn, and talk a little bit about Two Dads on Money. Don't go away.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to Two Dads on Money this morning. John Penn, how are you doing, sir?
Good morning.
Good. Did you have a nice holiday?
It was quick, but it was nice. We did a lot of hosting.
Yeah.
So I felt like I worked the whole time. So it's really nice to be back in the office.
I love holidays, right? And it's great when all the kids come over. And now it's interesting because all the kids come home from college. It's great. The house is full. Everything's very busy. And about a week or so into this, I'm like, please go home.
You're eating all my groceries.
Oh, I tell you, it's amazing how much garbage we generate when the kids are home.
So I am not a big New Year's resolution person.
Right.
There's just a certain way that I live. But when I was looking at how much we hosted and just the amount of waste we generated, I was like, okay, this year as a family, we are going to waste less. That is my resolution. Because like you, I was like pulling my trash out to the curb, and I was like, I am that neighbor on the block. It is overflowing. It's like we are going to waste less.
It is so true. It was very true. I'll tell you, and the funny thing is, like when we built our house, I put in this water filtration system. So we have like the water in our house is purer than the water you get out of bottles. But my kids insist on drinking bottled water, so they'll go buy bottles of water, and they're all like a quarter drink, and the bottles are just sitting all over my house.
Yeah.
So I just pick up all the bottles and fill up the coffee maker with them. So.
Yeah, like watering the plants.
Exactly.
Here, Earth, take it back.
Yeah. It is funny though. Anyway, I'm glad you're back. Happy New Year.
Thank you. Happy New Year to you.
So we got a few things to get into this year. So a couple of things here that we're kind of working on this morning is there was an article out by Kyle Scanlon just recently. It got picked up by the mainstream media, and everybody's running around with it because it made for great headlines talking about financial nihilism and this plight that plagues younger investors in today. I shouldn't say younger investors. It plagues our youth, right? This financial nihilism. And it's interesting. So I've written a whole article about this. It's coming out on Friday. So it'll be on our website Friday morning. And I go into a lot of detail within this particular article, but I thought we'd talk a little bit about it this morning as well. But just very briefly, financial nihilism is this growing belief, and again, it's among younger individuals, not older, that the traditional economic system and kind of conventional financial planning, that no longer works anymore, not for them. And the financial security of having the American dream is gone. And so within that environment, then, if that's the case, then why not just invest with as much risk as you can take? Because there's no negative consequence for that. Yeah, I mean, if I get rich quick, fantastic. If I don't, nothing changes. And I don't have access to any of this over here. I can't afford any of this. I can't get to where I want to go because the whole world is rigged against me. And this idea of financial nihilism only started about 4 years ago. This was right after the pandemic when everybody was locked up in their house. This YouTuber came up with this term, financial nihilism, and this is why. And it was to explain why these, everybody was chasing meme stocks and GameStop and AMC and all these other meme stock companies and doing these speculative IPOs and SPACs at the time. And it was all because there was no risk. Because again, if I gambled on these things and it worked, then fantastic. If not, I'm no better off or worse than I was before. So why not do it? Is this kind of idea? The problem is there's a tremendous amount of deep-seated fallacy to that whole idea, because the economy is not rigged against you. The functions of the market are not rigged against you, and the basics of financial planning haven't changed. And the real difference is that we've educated a group of young individuals to take on risk, this idea of getting rich quick because the markets have been participating, so why not do it? Hey, I get that. But the problem is the markets aren't always going to do this. Right. And you're going to eventually have a mean reverting event at some point that's going to put you into economic retraction, and it's going to feel like, well, it didn't work out, so it's no big deal. That's very much a victim attitude, is that it's always somebody else's fault and not ours, when in fact we have all the control we need to make sure that we are financially secure in our future.
Yeah, it's interesting. As I was, excuse me, just going through this and putting my own thoughts together, I just reflect on when I was younger. When I was, in my mid to late 20s, even my mid to late 40s, which wasn't too long ago, wink, wink. I never had the feeling that life was unfair or that I wasn't able to go accomplish the goals that I wanted to accomplish. I mean, I feel like in a way that this is almost like the expectation is, here, we're going to hand it to you. Here, just take it. I mean, you got to go out there and work for it. You have to go out there and work hard to achieve your goals and get success. And there was a mention in the article about it's amazing the statistics of the number of 27-year-olds out there that don't own a home. well, whoever came up with the age that's by the time you're 27 that you have to own a house.
Right.
I don't get that. Like, what's the rush?
Right. Well, I didn't
Right?
own my first house till I was in my late 30s.
Yeah.
Yeah.
So, and what's interesting is,
And by the way, I never actually owned my house because I'm still paying property taxes on it. So
yeah, that's going out later this month. Fun, right? But I find it interesting that, there are some stats that were in the article here that was written, and nearly 2/3 of Gen Z and millennials think that the only way to build wealth is through alternative methods like gambling and crypto, because I think there's a part of the younger generation, Lance, they're looking for, they want instant gratification, that we just don't have patience for returns anymore, right? They want instant gratification, and they're looking for more certainty with outcomes. And look, there are a number of younger investors that I work with, young adults, children of adult clients that I work with, and nearly 2/3, according to this article, nearly 2/3 of Gen Z and millennials think the only way to build wealth is through alternative methods like gambling and crypto. I must be working with the other 1/3, because that is not even in their mindset. Yes, I mean, not just the younger generation, but just about, there's a number of clients that I work with of all ages that have some of their money allocated to non-traditional assets, maybe cryptocurrency, et cetera. But it's just a small piece. They just own it as part of an overall diversified portfolio. They're not putting 25 or 30 or 40 or 50% of their wealth in this.
Right.
And I think some of the fallacy is, well, let's invest in cryptocurrency because you're going to get a lot more return quickly and there's a lot more certainty. When I looked at Bitcoin last year, it was negative.
Right.
It actually had a negative year. So, I think there's just there's some bad advice going on out there. And I think some of these younger investors, they just, unfortunately, they don't know any better.
Well, and the idea with this term financial nihilism, right, is it's great for marketing and media and getting clicks and views. And she got immediately interviewed by a lot of Wall Street journals, those type of things. Great for her, right? She's creating a very nice business for herself, which is interesting because she's creating a very nice business for herself to generate capital and use the economic system to her advantage while she's complaining about how the economic system is not fair, right? So it's always interesting when people take on these tacks because they're doing exactly what the economic system is built for. What capitalism is built for is to take an idea and then build it and grow it into something that creates income and opportunity. And that's exactly what she's doing. At the same time, though, she's saying that the whole system's unfair and it's rigged, and so that means it's rigged and unfair against her. But that's exactly what she's using to get there. So again, it's always important to kind of look through what's going on. It's a great term, but actuality is that if you take a look at one of the complaints is that baby boomers have all the money. Yeah, they have more money because they've had a lot more time to generate wealth. They've been alive, for the last 60 years, building wealth in the markets, right? Saving money, investing, doing whatever they're doing. So yes, they have more wealth than the Gen Xers or the Millennials or the Gen Zs. But Gen Zs are growing wealth at a faster rate than any other previous generations. Right? They're saving more, they're investing more, they're doing the right things to build their financial future. And again, when you take a look at a large majority of the kind of the Gen Zers themselves, they're actually starting to do the right things. Now they're still making mistakes, they're still falling into some of the speculative areas, but at least they're saving and investing at a much younger age. And if we can kind of help guide them and say, look, instead of taking on a lot of excess risk in your portfolio, which may wind up wiping you out and generally does, have some speculative risk in your portfolio, but have a portion of your portfolio that's more determinate about how future markets are going to, outcomes of markets are going to be. So, and save money, right? You can afford a house, you can afford all these things if you save and grow your wealth for them. And again, that's just kind of a function of what's actually happening in the markets. But these headlines about financial nihilism, et cetera, they're great. They just don't really hold a lot of truth behind them.
Yeah, I agree. A lot of the younger investors that I'm working with, excuse me, they really want to get things set up almost mechanically at a young age, where they set up their contributions to their Roth IRAs, to their traditional IRAs, to their 401k plans where they want to get this all set up where it's kind of set it and almost forget it a little bit, where it's an automatic, almost like a dollar cost averaging in every pay period or every month. And they just know that, and there's a lot of education that I give. It's like, look, when markets are higher, you have money going into your IRA every month, you're just going to buy a little bit less. Hey, if markets pull back, hey, guess what? Stocks are on sale. You're going to buy more shares with your dollars, but just keep investing and don't let these short-term narratives or these short-term swings of the market sway you from focusing on the longer term. Look, is it okay to speculate, like Lance mentioned? Is it okay to speculate with some of your assets? Yes, it's fine, as long as it's all within balance and you're speculating with money that, hey, if you lose, you're not going to upset the apple cart. You're not going to derail yourself, right? But if you speculate a little bit and, hey, if you hit a home run, great. But it's just all about balance. I just get concerned when I visit with younger investors where, maybe they're looking to allocate 50 or 60% of their dollars to, let's say, various cryptocurrencies. And when I ask them why, it's all the things that you hear Lance and Michael and everybody else here on the team talk about. It's the demise of the dollar, America's going away, et cetera. It's like, look, let's have a true, educational discussion here about why are you investing in the certain investment classes that you're investing in. Again, don't let these narratives sway you. Right?
No, and again, there was a comment about the American dream, which is, somehow we transform. The American dream is not owning a house, and somehow we transform that. Yeah. And this really occurred right after 2000. Alan Greenspan started pushing adjustable rate mortgages, and everybody needed to be in a house, et cetera. And all of a sudden, the National Association of Realtors, the group behind promoting, realtors that make money off selling houses, really started pushing this whole idea of the American dream is the future of home ownership. And that's not what the American dream was. The American dream was people leaving other countries where they had no opportunity to come to America with 2 nickels in their pocket and build something, right? And eventually wind up having wealth, and kind of the epitome of that wealth, or the end goal of that wealth, was owning a home. That was kind of your symbol that, hey, I've made it, right? I've achieved the American dream, and not only have I achieved the American dream, I now own property here as well, which wasn't available in other countries, right? So, we've kind of bastardized what the American dream is. And if you go back and look at Paul Mitchell, as an example, the founder of the hair care, salon products, he came here with nothing to the country and built this empire. And that story goes on and on and on. Elon Musk is another good one. But there's a lot of people that have come to this country with nothing in their pockets and have built a significant amount of wealth. That's what the American dream was that opportunity to have freedom to be able to build something and to take advantage of something. Again, Kyla Scanlon is a good example of this. She's doing that. Mm-hmm. She's at a young age. She's 27 years old. And this is another thing that cracks me up, John, is there's all these young people in their 20s running around saying, oh, this is the way the world is. And let me tell you what, you don't know dick at 27 years old. I'm sorry, but you don't have any experience as to what goes on in the actual real world and how things work. So, it's kind of like, go sit down in a corner and let the adults over here play. But you're going to learn, eventually how things work out. And this is going to be an important, kind of an important point here, which is, experience is a really good teacher, and the younger investors are going to learn through experience how markets work over time. I did too, right? I came through the night, I started investing in 87 when I graduated college. I've been managing money, through the crash of 87, the dot-com crash, the 2008 financial crisis. I've been through all of those. And I have made a ton of mistakes, and I have had plenty of setbacks over time. I've had businesses fail. I've had all kinds of things happen over time, and each one of those events taught me what not to do in the future. And so when I built the next business, or when I was doing the next thing, or making my next investments, I'm like, hey, I remember that I did this before. I'm not going to do that again. And that's what's made me a better investor over time. That's what's made me a better business owner over time. It's what's helped me generate more wealth over time, is that experience. And I just find it always interesting is that these young people are running around with absolutely no experience, convinced that this time is different, that cryptocurrency or whatever it is going to go to $1 million and they're going to make all this money. It may, but the odds are there are going to be some significant crashes along the way, and they're not going to survive those downturns, which most people don't.
Yeah, and by the way, that's probably one of the best comments I've ever heard you say. But there's a lot of truth to that. I look at how I was in my early to mid 20s, and I thought I knew it all, and I was going to go. But I've learned so much over my own career too. And have I made mistakes along the way? Absolutely. But I can look back and I can reflect on those too, right? And so I just find it interesting that she makes a comment. Scanlon makes a comment. Crypto prediction markets and online betting have rapidly expanded among younger adults because they offer immediacy and the possibility of outsized gains, something that the Standard & Poor's 500 index can't always replicate. Look, whether you are betting in sports, you are investing in stocks, you are investing in crypto, none of this is guaranteed.
Right.
Nothing. None of this is guaranteed, and and I guess I would like to know what is her definition of an outsized gain.
Right. Well, again, we've gotten used to 20% returns, right? So that's now become the average. We should always get 20% gains. So now outsized is now 30, 40, 50%, doubles, those type of things. We should get that every year.
Yeah.
Right. And again, that's just not the way the markets ultimately work. But the point is that there are some basic rules that ultimately are going to drive success, and there's just some things that we all have to do. And if you're younger, and there's always these. If you have 3 wishes, what would you do with them? And it's like if I could go back in time, I would do these things. We all have regrets about things that we didn't do when we were younger, and if I could go back, knowing what I know now, and redo things from when I'm younger, I would be way more wealthy than Elon Musk, because I would know what stocks to buy, etc. Right? But just going back, if I could talk to my younger self, I'd say, look, don't get into credit card debt. It's just there's no reason for that. There's nothing that you need that is that important. Right, that you think you need is that important, and just focus on saving money and investing, putting capital to work, starting a business. Look, I just had this conversation with my daughter yesterday, and she's, I've talked about her before. She's at Baylor right now. She's in pre-med, and she's trying to figure out what her life is going to be, and she's very determined to know exactly what tomorrow, like what she wants to know today, exactly what her future is going to be. I'm like, that doesn't work that way. I said, but you do have a choice. You can take a career where you will work for somebody else, and if you do that, you can make good money, but your income will be capped. You will never build true wealth by working for somebody else. You can save and invest your way to wealth, and that's fantastic, but to build real wealth, I mean we're talking, kind of FU money, type money. You're not going to do that working for somebody else. That is what you generate a potential for unlimited income when you own your own business. So if you are picking out your career, think about your career in terms of, hey, I'm going to take this career path and I'm going to go work for these people over here, and I'm going to learn how this business really works. But my end goal is to take what I learned and go build my own business, right? Build the better mousetrap. And that's where you can truly build unlimited wealth. And so when you start thinking about your future in terms of your opportunities, it's the opportunities you create for yourself through the choices you make. Choose the right career path, give yourself a skill set that will allow you to basically at some point generate and grow your own business, because that's how you build real wealth. And then of course the investing and the saving and the financial planning are all critically important to achieving that goal. And here's the true story of this. Nobody's holding you back from doing this. It's a lot of people say, well, I'm not able to go out and create my own business. Yeah, you are. people are throwing money right now. Private equity money is throwing money at everything that moves, and that doesn't even matter if it's a good business. They're funding them right now because they have so much capital. There is so much capital out there to take advantage of. All you need is the right idea. Get that business started. Do it on a shoestring. Do it in your garage. I mean, I can't tell you how many thousands of millions of businesses have been built in somebody's garage that they have turned into something that was really a wealth generating machine. It can be done, and you can do it. You just have to have the confidence in yourself to do it, and most importantly, be willing to suffer the failures. That is going to occur. Whenever you start a business, you're going to fail. You're going to hit stumbling blocks. Things are not going to work the way you expected them to, but you've got to persevere through that. The reason that 80% of all businesses fail within the first 2 to 3 years, there are two reasons. One, they're undercapitalized, or two, they're not well run. In other words, somebody goes in and they go, okay, I'm going to start this business. I'm going to take out $100,000 a year for my salary because that's what I need to live on. You can't do that with a small business. It's not going to survive. There's not enough capital there. So generally the thing is you're going to starve for the first couple of years, but if you struggle through that, you work a full-time job, you do this part-time job on the side, building this business, and eventually at some point that business will be able to support itself and you, and then you can leave your full-time job and do this as a full-time career. You can make that transition. But you have to start taking those steps. And the younger that you start making those steps and start making those strides in that direction, have the strong financial planning in the background, understand your cost controls, control your spending. Those are the things that will get you to success over time. But it's not fun. You're going to have the ability to say, no, I'm not going to go buy the new iPhone this year. And I'm going to have to use my flip phone for another year, whatever it is. Those are the choices that you can make, and those are opportunities you have to say, look, yes, I can live like everybody else today, and I'm going to live like everybody else tomorrow. In other words, you're not going to succeed. Or you can choose to not live like everybody else today and live like nobody else tomorrow. And the famous words of Dave Ramsey. Yeah. You have that choice, but you've got to be willing to sacrifice to do it.
Yeah, the sacrifice is such a key word. There are a number of clients that I work with right now, Lance, where they kind of had their day job, but at the same time they are building, designing their own businesses. There's one client where he has his day job and he's actually forming 2 corporations off to the side. And I think he averages about 3 to maybe 4 hours of sleep a night on a good night, right? I mean, they're just putting in a lot of time and a lot of work and a lot of sweat equity, but there's also a vision. There's a well-documented vision on, I'm going to take these steps now, I'm going to sacrifice right now, but this is what the goal is longer term. And going back to the financial planning, we've wrapped this all together in a plan as well to say, okay, well, as this materializes, what can this look like? Making some reasonable forward-looking assumptions, right? But there's got to be a commitment there. There needs to be a vision, and document what you're going to do. Write it down, put it on paper so you can see it. It's almost like a vision board, right? Where you can just visualize this and keep yourself on track. So you got to that helps me with my own dedication and my own discipline as well. But when you were talking through that, Lance, you were talking about the financial planning and getting like return on investment, and returns are important, obviously, right? You want your money working for you, and you want to get even good returns over time, right? But I think what's even more important from a focus, I think the market as investors, we are also trained on trying to beat the market. Well, what is a outsized return, right? Because we're used to the market being up in the high double teens to 20% per year, right? So if I'm only up 17%, the market's up 20, what am I doing wrong? I think what's more important to focus on is what is your savings rate?
Yep.
Right? What are you actually saving? And start that as young as you possibly can. So like you're under 50 this year, you can put $7,500 into a traditional IRA, and $7,500 might seem like a lot right out of the gate, but if you can set that up to where that's monthly, and I had all my notes here and now I'm completely missing it. Here it is, $716 a month. You might go, $700 a month, $716 a month? I can already hear it. I can't afford that. My budget doesn't allow it. I bet it does if you go through your budget and just weed out those things like Lance was talking about. Is this a need or is it a want? Go through your budget. Get your wants out of there. Just focus on your needs. I bet you can find where you can contribute $700 a month to an IRA. Just put that discipline in place at an early age. It'll pay off over the long run. I'm telling you right now, it'll pay off. Just start at an early age. And it sounds so basic, but it works. And just with my own career, when I look at investors that are much older in their career, where they got their start, like looking at our daughters. Our daughters are 23 and 25, and much like yours, they want to know right now what tomorrow's going to look like. We don't know. We don't know what the world's going to look like a week from now. But here's what we can control. We can control what we spend, and we can control how much we save. Just start saving early. Some of the most successful investors that have been generating wealth over time, they have started as soon as they could put money aside. They've started saving as soon as they can. Right.
Well, no, it's just fascinating. I was listening to a guy the other day, and he was being totally sarcastic. Right. Just mind you, this is what I'm about to say it was in total sarcasm. But he actually made a fairly good point, which is, there's all this running around. It's like, billionaires shouldn't be billionaires. We need to tax billionaires like 90% of their income. Okay, but billionaires are a billionaire for a reason. Elon Musk is a billionaire for a reason, because we're all buying his product, right? And when you start thinking about it in this manner, right, we facilitate Tim Cook and of Apple and Elon Musk of Tesla and these other billionaires in the country. We facilitate them being billionaires by buying their products. If we didn't buy their products, they wouldn't be billionaires, right? So in sarcasm, he said what we should do is we should put spending controls on poor people. Instead of taxing the billionaires, let's put spending controls on poor people. So in other words, if you have less than $50,000 a year in income, now he's being totally sarcastic, right? This is not serious. But he makes a good point with this. If you make less than $50,000 a year, you're not able to buy an iPhone. You're restricted from that. You can only buy a flip phone, right? That's it. That's all you can do. If you go to the store, you can't buy certain things, right? You can't shop at certain high-end stores. You can only shop at Walmart and Target. Okay, he's being totally sarcastic, but here's his point that he was making. He's like, look, if your whole issue is that rich people shouldn't be rich, then poor people shouldn't be able to just spend at will whatever they want. But see, immediately we go back saying, hey, it's my money. I can spend it on what I want. That's true, except what you're spending all your money on is what's keeping you poor. And this is to John's point, which is when you start looking through your budget about how much leakage there is, how much money you're wasting on frivolous things that have no return on investment over time, that's why you're staying poor. I just had this conversation with my son the other day. He's like, he's like, I like cars. When I have my own job, in my own career, I'm going to have nice cars. And I'm like, that is a terrible idea. And he's like, why? He says, I like cars. I go, cars are a depreciating asset. You buy it, you immediately lose money on it. 20%, as soon as you drive it off the lot, you've lost 20% of the value of the car. And it depreciates the more you drive it. And I said, it's a terrible investment. It's a terrible idea. I said, hey, I went through that phase. When I was young, I had nice cars, right? One of my first cars was a 76 Barracuda, right? Love that car, right?
School, baby.
Yeah, love that car. But, all it did was get me from point A to point B. And so as I get older now, it's like cars mean nothing to me. It's like I drive a 2019 Toyota 4Runner. That's what I drive, right? I pay cash for it, and it gets me from point A to point B. But that's maturity, right? As we get older, we start understanding that the things we think we want as we're younger, because we see the flash, we see, on social media, everybody's driving nice cars. They live in big, beautiful houses, and we all need that, right? Because that's what we see on social media. But that's not real. And that is not what, is going to get you to where you want to be. If you want those things, that's fine. You can grow your way into them over time. But the things that you're doing today, and this was his point and being sarcastic about spending controls, is that we don't have spending controls for ourselves. And you almost need somebody else to come in and say, hey, here's your spending construct that is going to get you to saving 20% of your income, 30% is going to your entertainment, 50% is going to your needs. If you can get yourself on that budget and live on that, put spending controls on yourself, you can succeed. The problem is that we just don't do that.
Well, and it's hard. It's hard that, folks that we buy from, it's very rare that people pay in cash.
Yep.
Or they just pay in a lump sum. because now everything is designed where just, you can pay over with Affirm or with PayPal or with some of the other kind of, I think Klarna's one too, where, hey, you break this up into 4 payments or 6 payments. We're all now, I think consumers are trained to pay for something in payments, even things like groceries. Man, I read an article not too long ago, Lance, where folks are, using payment plans for, Botox and Dysport for all of the, all of your wrinkle remover treatments out there. Really? To me, that just does not make sense. But as a society, when you're talking about spending control, I don't think society has spending control because it's so easy just to break everything down into payments now. Right. It's very rare that, like when you said you paid for your vehicle in cash, it's very rare that somebody can just go pay for a vehicle.
But I saved up for it.
But you saved up for it.
Yeah.
Yeah.
And it took me about a year, but I saved up for it, and then I went and paid cash for it.
Yeah.
So, but again, that's and this is why when you have savings accounts, you have multiple. I have multiple savings accounts. I've got vacation accounts. I've got any major purchase, I'll set up a savings account for that, and that way when I fund those, then that's what that money's set aside for, and then that money doesn't get spent for anything but that.
Yeah.
But that's on top of the other savings that I'm doing on just a normal basis, 401ks, Roth IRAs, those type of things. Whatever the other accounts are, the other savings programs, that's on top of that's not in place of my other savings, it's on top of my other savings.
Yeah.
If I can't get there, it doesn't get there.
So what he's saying is that he pays himself first.
Yeah.
What a novel concept, right? I mean, that's what it really comes down to. So younger investors that are out there, pay yourself first, right? So you're what Lance is talking about, nice cars, vehicles. I'm going to tell you right now, vehicles in Houston just get beat to snot. They just do. Our roads are horrible. My vehicle.
Parking lots are horrible.
Parking lots are horrible. No matter where I park, the parking lot could be wide open, and I choose that spot, and I come out for the grocery store, and somebody's parked right next to me. I'm like, of all the spaces out here, you get to choose that one. And of course, then I've got what I call the Texas pinstripe, the shopping cart right down the side of the vehicle, right? I mean, cars just get beat to snot around here. So that's why, I mean, the vehicle that I drive a 2011 Nissan Armada, and I think it just turned 204,000 miles on it, and it's actually worth money when I've got air in the tires and gas in the tank. But as long as it keeps going and it has AC in Houston, that's all I need.
Yeah. No, it's true. Yeah. Like there's some comments in the chat about Jay Leno and that had did really well with this collectible car edition. That's different. Those cars were not for daily drivers. Those were collectibles that they stored in big warehouses and sold those at auction. Yes, anything that you buy as a collectible, that's an investment, right? It's art, collectible cars, collectible baseball cards. Those are investments. Coins, right? You buy collectible coins. Those are investments, right? Because I buy those, I hold them, and they increase in value over time because of scarcity. That's a different story. We're not talking about that. We're talking about going down at 27, 23, 24 years of age and buying a Corvette Z06 and go, I've got the car, right? That's fantastic. You can't afford a house to live in, but you've got a nice car. That's what we're talking about here. And so, this is just about a function of financial planning and doing those things. But here's the bottom line of the conversation today. Financial nihilism is not real. It's a great headline. It's a great storyline. It certainly appeals to, tugs on the heartstrings and emotions of young individuals that feel like they don't have any future because they want it right now. Yeah. I've got to have this now, and because I can't have it now, there is no future. We've all felt that way at one point or the other. But what we can't do is become the victim in the story and blame everything else in the world for our shortcomings when our shortcomings are our own fault. We have to start the process of setting up a budget. I'm going to save 20% of my money and invest that. I'm going to invest, 30% of my money is going to go to my food, my entertainment, those type of things. 50% of my income is going to go to my needs. That's my house, my utilities, those type of things. Once you can get yourself on a budget and start saving that 20% of the money, everything else opens up for you. Not today, not tomorrow, not next month or next year. But in the future, that 20% that you're saving and investing will open up doors for anything else that you want to have. You want a big house? Great. You want to have, nice cars? Fantastic. Here's the funny story about this. Everybody that I've ever met that have saved and invested over time will not spend that money. They learn to live on that 80% that they're spending and saving, and their income drives that. And then all of a sudden, they stop wanting the big houses or the big cars or whatever it is. They're more focused on growing that wealth. That becomes their new trophy that, hey, I'm 30 years old and I've got $500,000 in the bank. That's their status trophy. It's not the car and it's not the house.
Yeah, and earlier when I was talking about going through your budget and trying to set aside $716 a month to make a contribution to your IRA for 2026. Maybe you go through your budget and you look at that, and maybe you literally don't have $700 that you can put aside every month. Maybe it's $200. Maybe it's $100. Maybe it's $300. Whatever it is, start.
Yeah.
Just start. Get into the discipline, because if you can just start the discipline, then the more your income grows, you already have that savings mentality. Just start. And too many times I also hear, well, I'm waiting for the perfect time to invest. There's never a perfect time to invest. Just start. Just start. Get that discipline started at an early age, and you'll be much better off in the long run.
One last comment. We'll wrap this up today. Is like, why pay cash for a car when you get 2.9% APR loan or less? You're in debt, right? The whole point of paying cash for a car is that you've saved up for it and you're not in debt. And to get and again, for a lot of individuals, that financing is not 2.9%. It's a lot higher rate, and it's for a lot longer term, because this is why we're starting to see car loans push out to 8 and 9 years to get a payment that somebody can afford for the car that they want. And I saw a really interesting commercial the other day. There's a I think it's a company called Drive Time. Don't correct me. I'm not sure if that's the right name of the company, so correct me if I'm wrong. But they have make your own payment, which is they have an app, and you can say, okay, I want to put this much down, and that'll be how much your payment is, or I can put less down, and this is how much your payment is. So again, I can buy a bigger car as long as I can put less money down and just finance it longer. The longer I can finance it, the cheaper I can make it. So, the problem is that you're getting yourself into the debt trap. The whole point of building wealth is to stay out of debt. Do not get in debt. That's the biggest deterrent to people's wealth in the future. The only debt you should ever have is the mortgage on your house, right? Ultimately, that should be your goal. It's like, if I have any debt, it's going to be the mortgage on my house, because that's an asset that will appreciate over time, and that's fine. But cars, credit cards, all that kind of, those types of debts will keep you poor long term. Credit loves to give you money, right? The banks love to give you money. That's how they get rich. You don't get rich being in debt. They get rich by loaning you money. And so reverse that game. Stop playing their game. Again, as you get older, learn to become the lender, not the borrower, because that's how you make money.
Yeah, and I think that we could maybe have a whole episode on good debt versus bad debt.
Sure.
Right.
We can do that.
Mm-hmm.
Yeah. So anyway, all right, that wraps up the conversation. Look, financial nihilism, not real. You can do this, right? Just start the process today. And just start making small steps towards building your business, starting your business. These things are not hard. Come up with the idea. It doesn't have to be a new idea. It just needs to be a better mousetrap than somebody else's, right? So even if the idea already exists, don't just willy-nilly say, well, it's already been done, I can't do it. If you can do it better, if you can build it better, you can do it more efficiently, you can do it cheaper, whatever it is, there's an opportunity for you to take advantage of. And go into Amazon and look at all the crap on Amazon. People have come out with gadgets for just about everything, right? And you look at some of the stuff and you're like, who would actually use that? And they sell 1 million of them, right? There's 1 million suckers out there that will buy your gadget, right? Just come up with something, start the process. Maybe the first deal doesn't work, maybe the second doesn't work, but you stay at it and eventually you create success and you'll build wealth. It's just the way the world works. It's the way that capitalism works. Capitalism is not broken. Capitalism is not dead, and the American dream is still very alive, and you can certainly take advantage of it. All right, that wraps up the show for today. Be sure and get your tickets to the upcoming Economic Summit. January the 17th. Tickets are online, available right now. It's going to be a really great conference. We got a lot of topics to cover about investing, financial planning, all the things that we talk about here on the show. A lot more detail at that conference, along with some ebook giveaways and a whole variety of other things. It's going to be really great. Love to see you there. Get your tickets today online, and we'll see you back here tomorrow for the live Q&A section with Danny Ratliff tomorrow. Live Q&A right here on the show. We'll see you tomorrow on the next edition of The Real Investment Show.